Well, I want to welcome you all to another one of the boot camp series. Now, before I introduce Daryl and Chris, I just want to make a quick comment because this conversation is mostly going to be between you and Chris Pedersen. But this was supposed to be the ninth in a series of these boot camp presentations. And the reason that we make it last is because everything up to that point has taken you, if you go through the first eight of the series, it will take you through the process about equities versus bonds and what equities and how to combine them and how to add fixed income and how to add money into them during your accumulation years and then how to take money out and then target date funds. And so we finally get to the end of the series, the ninth piece. And that focus is about what actual specific investments you make. There are thousands of ways to combine a bunch of different equity asset classes. But I think there's some magic in the actual ETFs that you might put your money into. And of course, that magic will be either better performance or worse performance. So we're moving this way up in terms of the release because I know that many of you are waiting, and this is the part you really want to know is what are Chris's new recommendations. So before I talk to Chris, I will talk to Daryl. I just want you to know that Daryl and I are going to be really passive in this presentation, but we're here to ask questions if they come to our mind. But Daryl is the one who has been responsible for putting all those amazing tables together that we have on our website, that as you go through about one through seven, all of those boot camp series, you're going to see Daryl's work. And it is so helpful to me as the teacher to have the access to those tables to help tell the stories. So Daryl will be here along with myself to watch and weigh in from time to time. But the person we're going to be focused on today is Chris Pedersen, our Director of Research. And I noticed in a recent piece that you did, Chris, that you were introduced as the Director of Education. And I don't know which one you prefer. I suspect you could fulfill either one. But Chris changed my life and the life of the people who follow our work. And the reason he did is because he came in and he simplified things. He took us from 10 different mutual funds or equity asset classes down to 2 or 4 with virtually the same return. It's not magic, but it's certainly meaningful for people who have to do the daily work or annual work of taking care of their portfolio. And then he did the work to create the best-in-class ETFs, taking the time to do what is in many ways probably the most difficult task for people. Because if you, for example, if you watch the first boot camp about stocks versus bonds, once you get that, you got it. You know that you want to have, if you're an early investor, a lot of stocks, if not all equities in your portfolio that's for the long term, and that bonds are going to slow you up in getting where you want to go. So that's a pretty easy lesson. And then you simply have to have the discipline to do that. But where it gets dicey, I think, for people is wondering, okay, I've got these 4 different equity asset classes. What fund should I be in? What ETF should I be in? And to the extent that the ETF that you are in, that Chris recommended, let's say last year, hasn't been the hot performer, now you're wondering, well, I wonder if we've made some mistake. And so you go through this process of questioning, am I doing the right thing? And so Chris is here today, not only to update us on any changes in the recommendations, but to explain for people who are here for the first time, how does he do this analytical work? How does he decide that one ETF for the long term should be better than most of the others? So, Chris, I can't thank you enough, just as I feel about the work that Daryl has done. You guys have certainly changed my life. I really mean that. And I'm excited. I have not seen this presentation, so I am quite excited to see what you have to say. And so the floor is yours.
Well, thank you, Paul, and thanks, Daryl and Paul, both of you, for being here because I think you have a lot more to offer than just sitting in the background. And I hope we have some interaction and discussion as we go because there's a lot that goes into actually understanding this process and applying it. And so, please don't hesitate to chime in. And my title hasn't changed. Tom Cock just I think he misspoke when he introduced me. I'm still the director of research, but it's a little organization. We get to have highfalutin titles.
Right.
Basically, Daryl and I turn cranks, right? So the crank we're turning today is one I promised to have done by the end of February, and it is February 27th, right? I mean, we're like right at the edge. This was one of the hardest updates of the best in class ETFs that I've ever done, primarily because there have been a lot of new funds that came along. And I wanted to do some things differently to be more transparent and help investors make good decisions. And so we got a lot of change. Let me share the document here. Okay, so I didn't want to bury the lead for people who followed our work for a long time. We're making two communication changes this year and four fund changes. So the two communication changes, the first one is that we are including a relative factor predicted expected annual return for each fund in each asset class group. And you'll see that later, but what that means is there's a number next to the fund and if the number is one, that means that there's a 1% per year expected return higher than the worst fund in that group of recommended funds. And you'll see where that number comes from as I go through my process and describe it. But the reason it's there is to help you if there are costs associated with changing from an investment that you currently own to a new one, that you can get an idea of how long it might take to pay for those expenses, right? If there are taxes to occur to be paid in a taxable account, for example, you might look at it and say, well, if there's only 0.25% difference in expected return, then maybe it's not worth making the change. So I think that transparency will help you make smarter decisions. The second thing is that we're breaking out the mid cap value asset class. And the reason we're doing that is that the fund that we've historically recommended for large cap value is actually better characterized as a mid cap value fund. And so we now have a recommended fund that is truly in the large cap value asset class. And you can also see some alternatives in the mid cap value asset class if you want to either stick with the fund that we had recommended in the past or go with something else. So those are the two communication changes, and you'll see those later. And then the four fund changes that we're making, and this is more than I'd like to make. I would really like it to be stable forever, but when new funds come along or new performance track records come along, I have to follow the data. And some people will say, wow, you have four new Avantis funds recommended. Are you just like totally biased towards Avantis? And the answer is no. I followed the data and I'm being transparent with the data. I'm sharing it with you so you can see it. These funds they are the best in their asset classes for what we recommend. And so Avantis Large Cap Value replaces the S&P 500 Pure Value Fund that was previously an Invesco fund that we had selected. And that's because, as I already said, that RPV fund is more of a mid-cap value fund. So this is more representative of the asset class. You still have the option, if you want to tilt a little bit more to small and use RPV, and you can see the difference in the relative returns in the data that I'll show later. The second change is the Avantis Small Cap Equity Fund AVSC replaces the iShares S&P Small Cap IJR. And you'll see again that it has a higher expected return, and that's why the change. And then the third change is AVDS replacing the Schwab Fundamental International Small Cap FNDC. And again, it has a higher expected return. This is a factor predicted expected return, so it could underperform for years. We don't know when that'll show up, but we just have to go with the data. FNDC, though, is still in the M1 portfolios, the M1 pies. And the reason is that AVDS is not yet available on the M1 platform. So, this is one of the reasons we give you multiple fund choices, is that you may not have access to the one that we chose as best in class. And then the last change is the Avantis Emerging Market Small Cap Equities, AVEE, replaces the iShares MSCI Emerging Market Small Cap EEMS. It's quite a bit less expensive, and I think has a very good chance of outperforming, and its track record says that it should. So those are the changes, but to really understand why you might care about any of these recommendations, I think we should go through the process. Did I miss anything or confuse anything here, Paul and Daryl, at a high level before we go through why people might want to go with the choices?
I think that was great. I have a bunch of questions already on my piece of paper here, but they really are for the time when we dig a little deeper
Okay.
into the choices.
I think
All right.
it's a good intro.
Okay, let's go through the process then. I just didn't want to bury the lead, so for people who've followed our work. So I'm going to back up just a little bit and say, how do academics come up with these ideas that investments are driven by a particular set of values? Well, it's a lot like the way chefs come up with how flavors drive the way we perceive food. So if you go to a chef and you say, how do you construct a great meal? They're going to say, well, you mix together a variety of complementary flavors. It's not all firing on one dimension. It's going to have maybe a little bit of sweet and sour, maybe a little bit of spicy too. And those things are going to combine to deliver a really great experience for the palate. Well, academics have taken a look at what drove historical performance in investments, and they've come up with the same kind of intrinsic ingredients. They've said, what are the attributes that drove returns? And they've come up with a variety of different models. So you get to pick one. There's in the same way I might be able to describe a car with a different set of specifications, there are lots of different ways to characterize the market. I like to go with the Fama French model because it comes from academia. It's not evangelized by somebody trying to sell me something. And this is their 5-factor model. It says that there's a market risk. That's the risk we take for being in equities. And that historically has driven the lion's share of the return, actually, for equities. But then there's also an additional risk that you can incur for investing in small companies. And for that risk that you take, you get a premium, you get an additional return. There's also some risk for investing in companies that are out of favor or value companies. They sell at a discount. So you can get more shares, if you will, compared to the value of the underlying assets of those shares for the same price than you could in a high growth company that is kind of a glamour stock. And historically, you've been rewarded for that. You can also get a higher return historically for investing in companies that are more profitable or more conservative in their investments. And so those are the five attributes.